Accounting Superstars. This is Professor Don Bush. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. Today we're studying intermediate accounting, the cash flow statements, financing activities. This is the second example, so let's get going here. We're working on Fred's Snowblower Service. It's based on a real business here in Colorado. So here we go. What I've got for us is I've got a couple of balance sheets. I've got one for the prior year, 2001, one for the current year, 2002, and we're going to look at the change between the two. Also, I've got some extra information because when you're doing the investing activities and the financing activities, a lot of times you need to dig deeper and find out what's going on. So here we go. So over here on the left-hand side with more information, I've got Fred paid dividends to shareholders in the amount of $10,000. Now in the financing section, any transactions that involve owners goes in the financing section of the cash flow statement. So here we go. Fred paid dividends to shareholders in the amount of 10 grand. That's going on the cash flow statement as a negative number. It's a use of cash. So coming over here to the balance sheets, mortgages payable. Last year it was $40,000. This year $35,000. Looks like it dropped down by $5,000. They probably paid down the mortgage a little bit, but we have to look into it just to make sure, double check. So here's the extra information. So number 2 here, mortgage payable, balance paid down by $5,000. So that will go on the cash flow statement, financing activities. And by the way, the kind of things that go in financing are long-term liabilities, not current liabilities, but long-term liabilities, and stockholders equity. So there you go, the transactions with owners. Coming down to note payable. Was $15,000, now $20,000 for an increase of $5,000. That's what it looks like, but we have to dig deeper. We might have to look into the general ledger, the general journal, maybe talk to people, maybe look up documentation, find out what's going on. So it appears that it increased by $5,000. Let's see what's going on here. I've got some extra information. Equipment purchased for $5,000. Paid with a $5,000 note. Now, no cash exchanged. No cash exchanged right here. Now, this is a cash flow statement, and so if there's no cash exchanged, it's not going to go on the cash flow statement. Years and years ago, it used to, but not anymore. So coming down the list here, deferred tax liability was $4,000. Now it's $3,000, so we have a drop of $1,000. It sounds like this deferred tax liability is getting paid, but the thing is that all taxes go in the operating section, not the financing section. So this is one exception to the rule. And I think it's about the only exception that I know of, where a long-term liability goes into the operating section. The people that made up the accounting rules and regulations, they decided they wanted all taxes to be listed in operation. Coming down to bonds payable, we've got $25,000 last year, $20,000 this year. Looks like we had a decrease of $5,000. I don't have any extra information on that, but this was paid down with cash, and that's all there is to it. It's going to go on the cash flow statement. Coming down to stockholders equity. Now, common stock was $10,000. Now it's $15,000 for an increase of $5,000. Now, before we get too far along here, common stock and additional paid-in capital, they go together. They're like brother and sister. They go hand in hand here. And so we need to consider these numbers together. So not only did common stock go up by 5, but additional paid-in capital also went up by 20,000, which is 25,000. And we can look at the extra information and verify this. So looking at number 4, Fred sold shares of common stock for a total of $25,000. There you go. So we'll put that on the cash flow statement in the financing section. All transactions that involve owners go there. Now, retained earnings. With retained earnings, we rarely ever have to look at it. Everything in retained earnings we already know. We know what the net income was by looking at the income statement. We also know that dividends were paid out, and we could find that on the statement of changes in stockholders equity. There's no reason to use retained earnings. So like 999,000 times out of whatever it is, don't use retained earnings. Don't look at it. Skip it. All right. Treasury stock. It's $6,000 last year, $5,000 this year. It decreased by $1,000. What happened here? And what's treasury stock? Treasury stock is common stock that the corporation has repurchased. It's common stock that the corporation is holding in its treasury. The treasury stock doesn't get to vote like other stock, though. Now, so let's look at the notes. So note number 5, treasury stock was sold for $1,000. So this is going to go in the cash flow statement in the financing section. So let's go down to the cash flow statement. And the cash flow statement's got 3 sections. We are going to look at financing activities, and I'm going to split the screen so we can see what is going on here. Dividends paid, $10,000 right here. We got it right from number 1 here, dividends. That is money going out, so it's negative. Decrease in mortgages payable, $5,000. We got that from the change here, and we verified it with information number 2 here. Mortgage payable balance paid down by $5,000, so it's a negative number. Decrease in bonds payable. They're paying down the bonds payable. We are not listing the note payable at all. The reason, again, is that we bought equipment and we signed a note payable for $5,000 and no cash was exchanged. This is a cash flow statement. If there's no cash exchanged, it doesn't go in the cash flow statement. Coming down here to stockholders equity, we have common stock and additional paid-in capital. We got to take those as a pair here. They go together. Sold common stock for $25,000, and lastly, we sold treasury stock for $1,000. And so if we add up all these numbers, we get a positive $6,000. This is the cash used by financing activities. And folks, that's not the end of the cash flow statement here. We've got 3 sections altogether. And just as a review of what goes on in these sections, here we go. The first section, cash provided by operating activities. What do you put on there? The net income or the net loss. Add back any non-cash expenses. Add back any losses. Deduct out gains. Look at the current assets. Did the current assets go up or down? Handle those accordingly. And look at current liabilities. Did they go up or down? Handle those accordingly. And then coming down to the second section, cash provided used by investing activities. This has to do with property, plant, and equipment. Long-term assets. Did we sell any long-term assets or did we buy any long-term assets? Then, of course, the lesson for today was financing activities. What kind of things go here? Long-term debt and transactions with owners. So there you go. There's the cash flow statement. And I hope you liked this lesson. And if you did, hit that like button and subscribe. And until next time, over and out.